I'm not worried at all.
Too far, too fast here?
No, I mean, what we saw in October 3rd through December 26th was just a correction. We've had 20 corrections since 2010. 14 were between 5 and 10%. 6 were between 10 and 20%. But interesting enough, what happened is people bought into indexes, and indexes work fine when the market's going up and up and up. But when you hit a flat market, down market, or a volatile market, it doesn't work as much.
You mean the buy and hold crowd?
Correct. And so essentially what you're seeing this year as it came back, people are looking at value, just not the overall market. You can buy 500 stocks in the S&P, but not all of them are good.
Yeah, well, as is always the case, Neil.
Right.
What you're saying overall is that the decline we saw through Christmas Eve was the aberration, not the snapback here that's been pretty quick and dramatic.
Correct. What you saw was the market was up like 2,200 points going in October of last year, then went down 5,400, and then snapped back 3,400. But the reality of the situation is you got over $5 trillion in cash on the S&P 500 companies' balance sheets. You got earnings are up, cash is up, cash flow's up, unemployment's low, people are spending money. Look at Walmart. I mean, everybody's looking and say the new headline now is recession. Well, Kelly, you can't have a recession when everybody's employed. It just doesn't work.
You're not committed. Before we get some of your stock picks here, Bob, have people said, wait, maybe we got too much ahead of ourselves with all this recession talk?
Well, I think people were really surprised by the strength of the rally. You put up the numbers there, 20% off of the bottom there. The market clearly telegraphed the earnings slowdown and the global growth slowdown way back starting in early October. So in that sense, the markets really are working well as a discount mechanism for figuring out a future stream of earnings growth. I think the market was very successful in telling us exactly what's going on. I think the problem now is, if you look, Neil was mentioning value. The value hasn't outperformed in this period since the bottom. We've seen really growth do better. High beta's done a little bit better. So people have sort of gone back to the old story.
Right,
gee, growth is really hard to find. Let's get it.
No, Bob, you're absolutely right. And I don't love the distinction between growth and value, Neil, anyway. So let's just talk about the good companies that you think right now are trading at an attractive price.
Well, what we try and look for is companies that have a price-to-sales ratio of 1.5 or less. And so we're not going to pay more than $1.50 for $1 in revenues. And so when you look at something like Casey General Stores, I mean, they're like one of the largest pizza operators in the world out there, but they concentrate in markets of 5,000 people or less. And they have a price-to-sales ratio of 0.5. So you're buying $1 revenue for 50 cents. That's one area.
And that also shows that you feel, you feel good about the consumer.
Very much so. You can look at American Eagle. Their price-to-sales ratio is 0.9. And
why does Neil Hennessy want exposure to a teen mall retailer, albeit that's had a hit with the bralette, Neil? But why is American Eagle so interesting to you?
I got 5 grandchildren, another one on the way. They got to shop someplace.
That's your channel check.
Exactly. But, retail is there. The consumers' confidence is there. The products are there. You can get them online. You can go to the store, do what you need to do. But there's so much value out there. I will guarantee you 90% of the audience out there hasn't heard of Trinity Industries.
And that's your last one, and you like them. Why?
Well, I mean, it's a whole different industry. Same thing. They have good earnings. They have dividends. Price-to-sales ratios 1. That's good. But, people won't know it that they do rail cars or make rail cars or barges. But they will know them when they hit the guardrail on the highway. So
they'll go, oh, that's what Trinity does.
Yeah, exactly.
Hopefully that's not happening too often, though.
No, that's why we go with Uber or Lyft.
But you like Trinity. Why?
Because essentially everything has to be replaced. And if you look at the United States and you look at how far we are backtracked or far behind on infrastructure, that money has to be spent there.